Hi guys, I wanted to let's get started with our first company presentation today on the top tier track, which will be moderated by the inimitable Maj Soueidan from geoinvesting.com. I'm gonna do that each time. So yeah, Maj will be moderating the session. It's a fireside Q&A with Data Communications Management. On behalf of Data Communications Management, we have James Lorimer from the company. With that, take it away, Maj.
Hey, thank you, Robin. Thank you all for being here today. So I'm really excited to do this here, and I think Bobby and I've been talking about this for a long time. Just start bringing, to have carve out a piece of the conference where we can start bringing in maybe some companies that meet certain quality factors, or if they don't yet are going to go that way. And I've been concentrating a lot more in Canada too recently, which is why I'm glad that James here agreed to be here from DCM. The stock trades on the OTC, DCMDF, and I think Toronto DCM.to. And the company is basically a print marketing communication type of business here. And James is going to talk about the transformation that the company's gone through since 2021 in March when the new CEO came in, Mr. Kelman. And we're going to get into that a little bit and how that turnaround has been successful. And also talk about, I guess, the transformative event for them recently. They just closed an acquisition yesterday at Donnelly of Canada, which is in the same business, where the company plans on kind of doing the same restructuring moves it did for DCM for Donnelly. So, James, let's get into it. So, tell us about, give us a little bit of the history of the company yourself, and then we'll get right into the growth catalyst. We're going to have like a half hour here and try and get into nitty and gritty of what's going on in the company.
Okay, Maj, thanks a lot for having me. Maybe I'll go to this page, which just gives a little bit of an overview of our company. DCM has been around for over 60 years, about 65 years now. Primarily Canadian-based. We do have some operations in the U.S. We have a small footprint in Niles, Illinois, just outside of Chicago, but really kind of a national footprint across Canada. What we do is we're in the kind of marketing execution side of the business. We do, well, print is kind of the key driver to, a lot of the things that we do. Our print is really kind of tech enabled, and we use a lot of technology applications to deliver pretty complex workflows for our clients. And our new tagline is surprisingly simple. And what that means is, we like to make things really easy for our clients. We manage a lot of real complex marketing and operations workflows for our clients. And we really like to say we kind of eat complexity for breakfast. So that's a little bit about what we do. Myself, I'm CFO. I've been with the company now for about 8 years. I joined in 2015. My background previously was in the capital markets. I was in investment banking for about 16, 17 years. I worked with a lot of small cap companies, helping them raise equity, do M&A transactions, and raise debt. And I joined at the period in 2015 where the company was going through kind of a really start of a kind of a restructuring. Since that period, we've made 4 acquisitions, plus the Donnelly transaction is 5, which is certainly our most significant one. But we've also been very focused on optimizing the business from a footprint perspective and from a headcount perspective. And we're about 900 people right now. When I started, we were about 1,500. With acquisitions, we added a couple and a couple hundred, and we've streamlined since then. And we've probably reduced our physical footprint by 1.5 million square feet across the country. So we've really been focused on kind of optimizing the operations of the business.
Thanks, James. And I really want to talk about the really meat of the transformation that occurred since Kelman came on board. And you've always had the technology a solution for your services, but it really wasn't being fully maximized, right? So that's just a little tweak in the business plan that's really caused a lot of great things to happen. And I think let's talk about what the gross margins were in early 2021 when he came on board, right? And then what they are now and why that gross margin uptake has happened. And then I'm going to have another question about the marketing platform.
Sure. So let me talk a little bit about our technology and what really differentiates us in the market. I guess for about 15 years, we've been building our own tech platform. We call it DCM Flex. And it's a customer-facing tool that allows our customers to, prepare personalized communications, procure products, kind of print on demand. It also allows them to do a lot of digital communication campaigns for their clients. Richard Kellum joined us just over 2 years ago now, and he'd done a little bit of consulting for the business to, kind of from an outsider's perspective, what do we really have here? And he comes from a marketing background, 35 plus years in the CPG market with, Mars Incorporated and Wrigley and a number of other kind of big CPG players. And as a marketing guy, he really kind of understood the technology we had. And I think we were really kind of underselling it. We used to, as we say, kind of give it away to get the print. Now we're doing a much better job of really kind of leading with our technology, and it really distinguishes us in the marketplace. Part of that platform is something called digital asset management. And, we've been managing digital assets for our clients for, probably 20 years. That's about a $6 billion market, and it's growing probably 24 to 35%, depending on who you look at. And we're in the process of building a kind of a standalone digital asset management software solution that should be in the market kind of mid-year 2023. We've already got some embedded digital asset management applications that are in a number of our platforms, but we think that, along with some other kind of marketing technology applications that we're developing and offering to our clients today, really provides some upside. Maj, to your comment in terms of margins, in 2015, we were about a 22% gross margin. We've been growing that literally every year, and last year we were 30.8% gross margin overall. So we've done a really good job at, trying to focus on growing gross margin. And last year, we'll get to it a little bit, but we've had some really good success growing revenue.
And you also, I think you have plans to go to 35 to 40% gross margins, right? That's the key.
Yeah, absolutely. And maybe a couple of slides here just to kind of put this in perspective. Last year was, really a breakout year for us. We reported total revenue of $273.8 million. That was up 16% compared to the prior year. And every quarter we showed sequential revenue growth. Likewise, gross profit, we had really a record year in terms of gross profit dollars and gross profit margin. We did a little over $82 million in gross profit. And again, gross profit was growing faster than revenue. Good news is also that gross profit was growing faster than revenue. So gross profit grew in aggregate about 21% last year versus revenue growth of about 16.3%. There was one other question there, Rep. Maj.
Yeah. So what I want to emphasize here, though, is the old DCM, it was mainly a lot of just maybe customers calling or faxing in orders. It was more kind of manual effort back and forth. Now you're requiring your logos to use the platform first, the software platform, DCM Flex. So they're able to go in there, integrate their own technology, and I think it was like some 70 pieces of technology they can integrate into the platform. So that's saving them money and you money, right, in terms of labor and stuff, which is where you're getting some of that margin improvement, I think, too, on the SG&A maybe, right? And they're liking that too. But was really interesting. You've gotten this gross margin kind of lift with only a fraction of the revenue coming from this new model you're kind of pushing, because there's still some of your legacy customers are still using Railway, right? And you got to get them over. So there seems to be some room there.
Yeah, absolutely. Of our $274 million in revenue last year, about $5.5 million of that was kind of a combination of technology, subscription services, professional services fees, and project management fees. And typically those technology applications are going to have higher margins than our overall business. We see that $5.5 million growing at a much faster rate than the overall business. And as that grows with higher margins, that should also further drive our margins. In that kind of margin profile, we've done a really kind of detailed analysis of all the different margin pools in our business. So we really better understand, which products are higher margin, which are the products we want to invest in for the future to really accelerate our long-term growth.
And that was one of the key things I liked about the company, where you have this wallet share opportunity where you can just go into your current customer base, which is, I think you say over 11 verticals, and be able to start kind of getting them, to use this new higher margin situation here.
Yeah, absolutely. And we've announced that we had 35 new logo wins last year. If you look at our kind of revenue growth, about a third of it was related to price increases. We had, pretty aggressive paper price increases that we were, pretty fortunate in being able to move those forward to our clients. We had about a third of that growth was from kind of mix, so different, mix of products. And then a third of it was from new customers. And those 35 new logos, virtually all of them were won because of our technology and what differentiated us in the market. If you look at our total revenue, about a third of that is what we call tech-enabled. So about a third of our revenue is generated by customers using our technology platforms to, build, procure, deliver, distribute their products. Our objective is to grow that third of our business today to 75% over the next 5 years. And as Maj says, we're kind of taking customers that might send in a purchase order over email. Very few fax things in anymore. That still does happen, but really, the more we can convert our customers to using our technology platform, the more embedded they are in our workflows and us in their workflows, and really sticky client relationships.
I want to give you to understand the product. You use the word digital transformation, but what's the role in your business, right? So you have Reflex, which is
you have Assemble, which is your kind of digital repository, right? And you have your newest, I think, product line, personalized or personal, yeah. And personal is a personalized video tool. So we're really strong in personalized communication. We like to say those two high volume is not really the market we play in. We're really good where it's high SKUs and low volume. So think about very customized communication offerings. And that's really, again, where our technology is. A great example of that would be in personal, which is the new tool we launched in the beginning of this year. So think about all the direct mail you get. It's personalized to you. It might have your name. It might have your banker's name. It might have the summary of your portfolio that was formed last year. So there's a lot of data in that today we're able to do that through physical printed communication. We're also able to do that through digital communication. So you're getting that by email. So you might get a application for a new capital one or something.
Have a bunch of personalized information in that. But as we all know, email response rates have gone down considerably since the advent of the internet many years ago when it was pretty sexy. Personalized video is kind of the next wave of communications. And so imagine being able to take those fields and personalize them with maybe a video of a person or mobile kind of animatic messaging. We have tools that can do that and offer that for our clients. So imagine if you're a private banker at a big bank, you've got a prospect list. You want to prospect and send out a campaign to your clients and your prospects, and you got to work within pretty strict compliance standards from your bank, as everyone can imagine. And so our tools allow a private banker or a wealth advisor to do that, and not only offer a physical printed campaign, we can also do a digital campaign, and now we can do personalized video to that. There's a few standalone kind of personalized video companies out in the market. We think with our client base and our capabilities that we can really be a leader in that market.
Now, that's one of the things that really got me interested too, because when you think about the print and marketing industries, I mean, I don't love marketing companies, how I think about them sometimes. So I was like, how are you different? And then print, what's so exciting about print? And so when you do read about the industry and where it's going. It's some sources say it's growing at a couple % rate. Some say it's flattening out in this attrition. But there's different growth pockets you start to learn, right? And they all talk about the one common thing is personalized type of video messaging, and also a one-stop shop for the customer for your clients, and that's what you're doing. So to really put this in perspective, this isn't just like a HubSpot. This isn't just a MailChimp or a Salesforce. It's basically coming in one spot and integrating all your marketing tools, whether it's your email marketing tools, your data analytics tools, your suppository of all your digital material like your logos, your branding, all those things. Anything you need for a marketing campaign, it's all can be driven to this platform through video. And then it finishes off with you guys usually printing this out, so printing it out, or you can email it too. And I want you to really possibly about 5 seconds. What's your competitive advantage against sign this? What is still a very common market. And one thing which I'm explaining is you look for complex problems, right? It comes to complex solutions because that makes them stickier and can give us competitive advantage. And there's a lot of companies that do boilerplate pre shops. So tell me more about that. What does that complexity mean?
Sure. A good example would be some of our financial services clients, and we would work with most of the major Schedule I banks in Canada. And when you look at a bank, it's not just personal banking; it's corporate and investment banking, it's wealth management, it's insurance. Many of these banks have 8 to 10 different business lines, and where we really excel is working across all those business lines. And each business line is often very distinct and has their own, distinct marketing teams or products, and they don't, really kind of break down the walls very well. And so what we're really effective at doing is working with these big enterprises, getting in there and helping them, kind of manage all this complexity. And while we're helping to reduce their costs of ownership and helping them run things more effectively, we're also able to add a lot of value to their service delivery. And if anyone's been into a bank recently, I don't know about the U.S., but certainly in Canada, customer service is number one, and the teller that you meet at the front is, she's bonus now or he's bonus now on customer service levels and rankings, and so that's a really big theme within all the banks.
And I think all these things together kind of supported maybe kind of an opinion I had was like there would be could be a PE expansion. This is maybe a 5 or 6, 7 PE industry for a lot of companies, and which is where you were at for some time, and now you're sitting at a 10. And I think going this technology route, and this all-in-one solution can give you expansion in your multiples moving forward. By the way, I should disclose, Bobby's going to get mad at me. I do own the stock, and I've owned it for about 30 days or so. So I'm a new shareholder, just getting used to it. And so let's talk about, since we have 10 minutes or so, and if there's any questions, you can always raise your hand and ask them at any time during this whole thing. Let's talk about the Donnelly acquisition, what it means for you, how big it is relative to your revenue. I mean, you finished the year at I think 30 cents Canadian, adjusted earnings per share, and maybe that's about 26 maybe US. I'm thinking. A little less, yeah. So talk about the acquisition, what it means for you, and what you expect out of it. And you did take on some debt, so I want you to explain the transaction details here too, because you spent the last several years paying down your debt from like $70 million to $20 million. Now you're taking on significant debt to do this.
Yeah, absolutely. So maybe a bit of background. Our Donnelly & Sons was a New York listed company, big international kind of print marketing communications business. They got taken private about a year ago in February of 2022. Global operation. We saw they'd been selling some assets in Europe and elsewhere. So we approached the executive team in Chicago, entered into discussions with them last year, and we thought there was an opportunity to, kind of merge their Canadian operations with ours. Relative scale, very, very similar. We're about $274 million in revenue. They're about $250 million in revenue. Very comparable kind of footprint right across the country. Very complementary in terms of the products and services that they have with ours. And that would be, things like commercial print, business communications. So think about, financial statements, processing and transaction statements, large format print, and there's one I'm missing, commercial print, and then, business forms and labels. So all those businesses are very kind of complementary to ours. We financed the transaction with debt from our two funding partners who've been with us for 6 or 7 years. Bank of Montreal is our primary lender. They provided a working capital facility, and Sierra Private Debt is a private debt funder. They provided kind of long-term fixed rate debt. The cost on that's pretty attractive. It's about 8.08%, kind of 7-year amortization. The revolver is about prime plus 85 to 125 basis points, depending on our leverage. And we also added a bridge facility. Think of the deal as $131 million in total. About $100 million of that is for the business, and we paid what we think is a very good multiple for that. And then $30 million is related to 3 real estate sites that they actually own. We're in the process of considering what to do with those sites. One, which is the largest, is in Oshawa, Ontario, just on the east end of Toronto. And we've entered into an agreement to sell and lease back that facility for about $23 million. And the proceeds on that will go towards paying down that bridge facility, pay off, the big chunk of that, so that brings down our leverage pretty nicely. So kind of pro forma, before that happens, we're about 3.2 times debt to EBITDA. After we do that, we'll come down to about 2.6, 2.7 times EBITDA. And then we see a really good path to getting our net debt to EBITDA down below 1 over the next kind of, 5 years for sure. But, depending on how quickly we go with some of the kind of growth opportunities we see, we could certainly see that coming down sooner.
Yeah, I think I had a question from somebody in my website who follows your story as a big shareholder, and he was wondering why maybe that's not going to come, why you would not paying debt a little faster, given how much cash flow you could probably generate here over the next several years. Are you just being conservative? What are some of the reasons there?
I think we're being conservative and we think practical. There is definitely some investment to make in the business on a combined basis. Our CapEx between the two businesses is probably going to be in the $5-6 million range per year. So the business is, certainly our business had very high free cash flow conversion rates. Their business likewise does as well. We'll have some investment in the business in terms of, right sizing the organization. But we think we've got some significant opportunities in the kind of 4 buckets, I guess, of synergies. One would be organizational savings. So where there's, maybe duplication in roles. Operational, we're going to look at all the facilities and see where we can streamline the footprint. And then, also we think there's some procurement opportunities where, collectively we think we could be, buying better and maybe sourcing better for some of the services that we contract from others. And then I think the big one that we're really excited about is revenue opportunities. We're not buying this just to cut costs. Far from it. We're actually buying it because we think the two combined businesses can grow. We put out guidance to the street yesterday when we put out our press release. Our plan is to grow the business at more than 5% a year organically over the next 5 years. We believe that our adjusted EBITDA margins can exceed 14% over that period. Net debt well below one times. And as we talked a little bit about our technology earlier, the MarTech kind of digital asset management, personalized communications, we think that business can grow by probably 60% a year over the next few years and generate 80% plus margins. So that'll certainly help drive higher margins in the business.
Now, in terms of the organic growth of 5%, what kind of assumptions are you making in terms of cross selling? Because there's not a lot of similar customers across the
Yeah,
business, right?
it's interesting. Only about 10% of our customers actually overlap. And although we've been, pretty big competitors for many years, it would be the larger customers. So probably 25 to 30% of our revenue would be with similar customers. But even in many of those cases, we may be providing certain products to a customer, and R&D Canada is providing different products to those customers. So we think there's a real opportunity to kind of cross-sell and upsell our respective capabilities.
And what I like to hear about this whole situation too is because you've already proven what you can do with DCM. We'll call it legacy for now, right? Reducing debt, getting your gross margins expansion. So you're basically just doing the same thing with Donnelley, right? And you've kind of proven you can do it.
Yeah, we've as we said earlier, we've grown our gross margins from the low 20s to 31%, and just organically, as it is, we certainly see we can grow our gross margin north of 35. With the combined business, they have some lower margin kind of product offerings and pools, and we're going to really tackle those, and we're confident we can kind of apply our operating model to their business.
You did say that there were some real estate assets. You're going to sell off one and do a lease back, and that's going to pay down some of your debt. You said there were also 2 other real estate assets that, if you were to sell those, what do you think that could generate for you in terms of?
Yeah, we've had offers. We think the value on those is probably in the $10 to $15 million range. So
each?
Between the 2.
Okay. So that would help pay down. And how serious do you think that might be considered as an option for you guys to do?
We're definitely going to be evaluating our footprint. We've done a lot of work, to date. We engaged Boston Consulting Group to help us with all our kind of due diligence, and then also with our kind of post-merger integration planning. And so we've got a real plan together, and we'll be assessing the other facilities over the next 6 months, and probably over the next year to year and a half, we'll come up with a solution there.
And I'm assuming that's not in your guidance at all. Like using that cash to pay off some of your debt is not in some of the.
No, in our leverage, yeah. When we said there's about $30 million for the real estate, we included those 3 properties in that.
Okay, great, cool. So I think that's it. And I really like this personalized video thing that you're doing here, and I like to see how that works. I know I get emails all the time now that are more personalized, and they do trick me to open them. So, but I see where that's going. So I really appreciate this. James Lorimer, CFO, DCM. Thanks for being here. And if you have any questions, he's great. You can get him. Where can they reach you?
My email is jlorimer@datacm.com. You can find that on our website, which is datacm.com, and all our press releases and marketing material is up there. Contact information for Richard Kellum is in some of our investor decks on our website.
Great. And I will say one last thing is that when you're thinking about this, and it's a low PE industry, if you look hard enough, there are some companies that have more of a growth solution or a techie solution that do trade in that 12 to 15 PE ratio situation. So that's something to consider here too. Stock has run up a lot. It's gone up 80-90%, I think, since you announced the acquisition.
Yeah, it has.
Yeah,
we announced the acquisition in March, and we've had a nice little boost in our share price since then.
Yeah, I guess I should ask you. We got 3 minutes. Why not do it? So the integration of Donnelley. What's that going to look like in terms of time frame? When is all the junk going to be taken out of it? Where we're start seeing some interesting accretiveness to either the gross margins or EBITDA margins.
I'd say that it's probably kind of 2 waves. By the end of fiscal 2023, we think we'll be able to get at a lot of the organizational efficiencies, and then and there's probably a couple of smaller kind of plant opportunities in that period. In 2024 and probably into first half of 2025. That's when we should see some of the more significant opportunities realized.
Thanks. That was awesome.
Great.
And we'll do it again. Yeah. Thank you.